Fundamental analysis is the key long-term driver of stock values. It can be a big subject. In this video, we're going to give you a basic introduction to what fundamental analysis is. Fundamental analysis is the type of analysis that you would do if you were going to purchase a business. When you stop to think about it, when you purchase stock, you are purchasing a piece of a business. To better understand fundamental analysis, let's use an example of a widget factory. If you were thinking about buying this widget factory today, what are the things that you would consider before making your offer? There's probably a lot to consider. Sales, sales growth, net profitability, margins, debt, reputation, management team, location, competition, the state of the equipment, value compared to competitors, expansion potential, industry concerns, and other opportunities you may have, just to name a few things. With a list that begins like that, you can see why we say that fundamental analysis can be a huge subject. There are two basic categories of fundamental analysis: quantitative and qualitative. Quantitative analysis deals with things that you can put a number on: profits, sales, rates, and ratios. These are all quantifiable things that you can use to help determine the value of a business. Qualitative analysis includes things like management team, brand recognition and reputation. There are varying approaches to fundamental analysis, but for this video, we're going to simplify them into two basic styles: value investing and growth investing. Value investors want to make sure they're getting a good company at a good price. It's not enough for a company to be great, it also needs to be trading at a discount to make it worth purchasing. If a company is trading above its intrinsic value, there may be an opportunity to short the company. Benjamin Graham, Warren Buffett, Charlie Munger, Bill Ackman, and Michael Burry are all famous investors that are considered value investors. Value investors tend to focus on price ratios, debt ratios, and dividend yields, among other things, to ensure that they're getting a good deal when investing. A typical value investor is looking for capital growth and income by investing in stable companies with good fundamentals that are not necessarily growing quickly. Growth investors are primarily focused on stocks with high revenues and high earnings growth potential. They aren't as much concerned about valuation as they are about future earnings growth. Thomas Rowe Price, Philip Fisher, and Peter Lynch are all examples of famous growth investors. Growth investors focus on revenue growth, often in newer industries. As a result, a growth investor can probably expect more volatility in their portfolio. Growth stocks don't normally pay dividends and often look expensive from a traditional valuation standpoint. One of the biggest factors in fundamental investing that investors should be aware of is a concept known today as an economic moat. A moat around a castle is a fortification that prevents enemies from breaking in. An economic moat is something that protects a company or gives it an advantage over its competition. Things like cost advantages, size advantages, intellectual property protections, and intangibles like reputation or brand name recognition can all act as economic moats. In the long run, fundamentals are what drive the market. In the short run, however, markets don't have to make sense. Panic selling, the fear of missing out, and unusual activities like the meme stock frenzy around companies like GameStop and AMC can cause short-term deviations from existing fundamentals. Fundamental analysis is a big topic and it can be intimidating. It can be made a lot simpler if you just ask yourself, do I want to own this company? Do I want to own this company at this price? And then take your analysis from there.